The dot-com bubble, also known as the Internet bubble or the dot-com crash, was a period of extreme exuberance and speculation in the stock market, specifically in Internet-based companies. It occurred in the late 1990s and early 2000s, characterized by the rapid rise and subsequent collapse of many Internet startups and companies. The bubble was fueled by the belief that the Internet would revolutionize commerce, and that any company with an Internet presence was destined for success. This belief led to gross overvaluation of Internet companies as investors rushed to invest in these seemingly promising ventures. During the dot-com bubble, Internet companies were valued based on their potential instead of their current profitability. Traditional valuation methods such as price-to-earnings ratios were largely ignored as investors focused on factors like user base, website traffic, and brand recognition. This led to astronomical valuations, with companies being valued at millions or even billions of dollars, despite having little to no revenue or profit. The mantra of the time was "get big fast," as companies prioritized market share and user acquisition over sustainable business models. The impacts of the dot-com bubble were far-reaching and had significant consequences for the economy and the tech industry. As more and more investors poured money into Internet companies, the stock market experienced an unprecedented surge. The Nasdaq, which heavily featured tech stocks, reached an all-time high in March 2000. However, this meteoric rise was unsustainable, and when the bubble burst, billions of dollars were wiped out from the stock market. The bursting of the dot-com bubble had several unintended consequences. Thousands of Internet companies failed, leading to massive job losses and a decline in investor confidence. Many startups that had received substantial funding suddenly found themselves without the necessary resources to continue operations, resulting in bankruptcy. The collapse of these companies also had a domino effect on related industries such as technology, advertising, and telecommunications, further exacerbating the economic downturn. The dot-com bubble served as a critical lesson for investors, entrepreneurs, and policymakers alike. It highlighted the dangers of speculative investing and emphasized the importance of analyzing the fundamentals of a company before investing. The excessive hype surrounding Internet companies taught the market the need for caution and groundedness. Following the bubble's burst, there was a significant shift in investor sentiment, with a return to more traditional valuation methods and a focus on sustainable business models. Moreover, the dot-com bubble paved the way for future advancements and innovations in the tech industry. Although many Internet companies failed during the crash, several key players survived and thrived. These survivors, such as Amazon and Google, went on to reshape the business landscape and became the powerhouses they are today. The bubble's burst also led to increased scrutiny and regulation in the tech industry, ensuring that companies were held accountable and providing more stable foundations for future growth. In conclusion, the dot-com bubble represents a period of excessive speculation and overvaluation of Internet companies. It serves as a cautionary tale about the dangers of irrational exuberance and the importance of considering the long-term viability of a business model. The bubble not only had significant economic impacts, but also shaped the future trajectory of the tech industry. They taught valuable lessons that continue to resonate in the world of investing and entrepreneurship, reminding us to approach innovation and speculation with a critical eye and a measured approach.